we've done a lot in the last 6 months talking about the influx of hedge funds and private equity groups that have come into the real estate market, driving prices up, creating a real opportunity for investors to really capitalize on what is considered to still be a down market. This was on just last night. I pulled this off the internet just this morning. This was ABC News talking about housing prices jumping 6%, 3% in October to compare to the same time last year, the biggest year-to-year gain since 2006. Prices rose in 45 states, led by 21% in Arizona, 13% in Hawaii. We are operating, as many of you know, in the Birmingham, Alabama market. We saw a 17% increase in sales prices from 2011 to 2012. So you're really starting to see some real growth in the market now, prices jumping in most major markets. If you have not read the article, this is last Time Magazine. If you haven't read it, I can either send you the link to it or got a copy of it. I'd encourage you to pick up and read Bill Zapparito's article about why investors are betting on the housing rebound. Very fascinating read. Gave a lot of really good details as to why you're seeing both large and small investors flock to this market. This I pulled off just today as well. This is the Wall Street Daily. It's April 13th. It's actually a report, obviously much too big to put on a webinar today, but it's a very good report that I read this morning. If anyone would like to get a copy of that report, I can certainly send you the link. You can click on it, download the report and read it. But it talks about, there's a lot of people that are saying, well, gee, the housing market's going back up again. What's the reality to it? Are we facing another bubble that's going to burst? And this report does a really fantastic job from an economic standpoint as to why this market's continuing to grow. And the key thing it says right at the front end is the real estate market is on the path to recovery, and there's no better time to buy than now. And I believe that. And I'm not just saying that because I'm part of a specialized real estate company, but because I think the fact is, if you talk to any institutional investor, hedge fund manager, which typically tend to be very smart people, they will tell you that the best place to put your money right now is in the real estate market. Standard & Poor's Case-Shiller Home Price Index, this was just last month, after the biggest housing collapse since the Great Depression. We've seen prices rise nationally after a 30% drop. Third quarter prices up 3.6 from a year ago. September 20 City Index reached its highest level in 2 years. You can Google the housing market, and you can go to almost any publication. Doesn't matter what you read the same sort of stuff. We had a collapse of the housing market. It's starting to rebound. There's never been a better time to invest, and the fact that institutional investors, including people like Warren Buffett, for those of you that have been on my webcast in the past, I've talked about what Warren Buffett suggested 1 year ago during an interview with CNBC, and that interview has kind of created a ripple effect to the investment community in that you now see these large institutional investors jumping into the market. National Association of Real Estate article, this is just last month, existing home prices jumped more than 9% in 2012, the largest increase in 5 years, and home inventory was starting to drop. I'll talk about that in a little bit when we get to hedge funds, as we have experienced some of that. Again, this is the National Association of Realtors. 84% believe the real estate values and the number of transactions will increase in 2013. There's no question about that. 77% believe that new construction will start to increase. We're already seeing those statistics prove this number out. 74% believe that their local economy will improve in 2013. And the biggest one is no market is expected to see a decline in home values or transactions in 2013. 1/3 of markets in 2012 experienced the same sort, experienced a downside, that downtrend into transactions and into pricing. The one thing that we learned back in late November and early December was, and it became apparent because we were competing with them on the ground, was that hedge funds and private equity groups were now in the game. And we believe that started when Warren Buffett made that quote, when he said that he'd buy millions of single-family homes if it were practical. And he said that on CNBC and just said that the best place to invest your money is in the real estate market. The question was, how do you do it? Well, what Warren Buffett did was, not being, for being a very smart investor, Warren Buffett went out and bought Prudential Real Estate. So now Warren Buffett owns Prudential Real Estate. So he recognized that the value in home prices, he recognized the value in being in the housing market, not being very handy himself. He wasn't the kind of guy that would go out and buy 10 single-family homes, fix them up, and rent them out. But what he realized was that there is a market here that can be taken advantage of. And so what's happened since then is hedge funds have determined that the real estate market is just the safest place for their money. There's lots of reasons. Now, we are interacting with hedge funds pretty much on a daily basis now. We've learned a lot. What's interesting to talk to these folks is the reason why. Why is real estate such a valuable commodity to funds that control hundreds of millions of investment dollars? And there's a lot of reasons for it, but the one main reason is, I think, that's common with everybody, is that the fact is that we've been almost going over this financial cliff for so long that there's concern that at some point in time we're going to see some semblance of it. I'm not saying we're going to have a complete collapse of the economy, but I think most of these folks believe that having their money invested in a commodity, not a stock, not a paper investment, but a commodity is a good strategy. When that commodity is real estate, in as much as you can buy it at a discounted price in a market that's down and growing, that's a great place to place your funds. You get monthly cash flow from the rental income that you receive, and the market is going up. The article that you'll read, if you choose to, on the Wall Street Daily talks about, will housing prices ever be at 2005 values again? And the answer is yes, it will. It's going to take a little while, but so what? You get into the housing market today, and if your strategy is 5 to 10 years to buy and hold a piece of property, if you buy something for, let's just say, $50,000, and it's going to go back to 2005 price, that means that property is going to go up to probably $80,000 or $90,000. And so there's value in that, and these hedge funds and institutional investors see that. So the question that we had was, is this a good or bad thing? So now we're competing with hedge funds. We've had this nice little business now for about 5 years. We're what's considered to be a specialized REO company. We've had pretty good success. But what's it mean now that you got hedge funds in the game? Well, it took us a little while to figure this out. Actually, it took us about 3 months to kind of figure out what this really meant for the market. And I pulled this article off the internet, and I capsulized what I consider to be the 3 main reasons why it's a good thing to have hedge funds in this business, institutional investors in this business. Here's the primary reasons. Number one, they're driving up prices. They typically buy at or above market value. So if a home is if the asking price on a home is $50,000, they will either offer $50,000 or $55,000 or $52,000 for that. So they're buying over the asking price of property, so they're driving up prices. They're also buying bulk list and tape, something that we don't do. But hedge funds will typically buy from a bank a group of 50, 60, 100 homes with a strategy no different than our strategy: fix it up, rent or install, hold it, cash flow, flip it at some point in time. But they'll buy homes that we would not typically buy. As a matter of fact, most specialized REO companies won't buy bulk lists and tapes. And the reason for that is just real simple. If you get 100 homes, you get a percentage that's excellent value, you get a percentage that's good value, but you're always going to get a percentage that is just really bad value. And so that drives down their rates of returns. Their rates of returns, they look for 7 to 9%. We tend to look for 10, 11, 12. But they'll take that lower number because obviously they've got a greater amount of money invested. Finally, the final reason, and this is really a great reason, this is great for anybody that gets into this market in 2013, and I really believe this is probably the best year to get into this market. It's providing an aftermarket. If you bought a home tomorrow, and you decided you to sell it in 6 months because you had some event, you needed money for college, your kid needed money for college, you lost your job, you needed to be liquid, you couldn't have your money tied up in an investment. The reality of it is there's buyers out there like crazy. If you've got a piece of property, you'll sell it. You can sell it to these hedge funds. I mean, there's just the fact that they're in the market provides an aftermarket for our clients and our investors, whether they're in it for a short period of time or for a long period of time. So the reality of it is the hedge funds in the market really is a positive thing for our industry. Now I'm going to talk briefly about REO Reseller, what we do, kind of what our formula is. We've been in the business, like I said, since late 2007, early 2008. Our strategy was really the same as what the hedge funds are now, which is just to be in the low end of the market, buy properties at pennies on the dollar from banks, primarily from banks, fix them up, rent them out, sell them to an investor, stay by that investor and work with them throughout the period of time that they own it to help them manage the property so that they have a company there to assist them and aid them in every aspect of managing the property, which takes away the painful stuff that goes into managing secondary home ownership. And that's sort of been our niche, providing a management contract to an investor to help them maintain their property without having to be directly involved on a day-to-day basis. This is our formula, and I'm going to show this again today because we always get somebody on these calls that want to do this themselves. They're just on here to listen to how we do it, and that's okay. The groups that we do webinars with, we have an obligation to them to counsel their clients whether they buy from us or they don't. So if they're going to do it on their own, this is what we do. This is our formula. First, you want to research the area. Make sure you're buying in the right market. We'll talk about our market in a few minutes. You don't want to buy everything you look at. You definitely want to cherry pick. I don't care whether you're going to buy 1 or 10. You do want to cherry pick. Leave the bulk lists and tapes to the hedge funds. You want to look for neighborhoods where rental values are strong. The rental market needs to be a strong rental market, and the resale values of homes have been consistent. You want to analyze a market for those two things. We buy REOs, foreclosures, and private party sales. We primarily buy REOs. REO, if you don't know what that means, by the way, means real estate owned by a bank or a financial institution, typically something that's been taken back from a bank or a lender, an institutional lender. As I said, we do not buy the bulk lists or tapes. I would encourage you to stay away from those. We don't look at comps as much as we look at yields. We look at something from the perspective of investment. What's it going to yield the client in terms of rate of return? Comps can be a slippery thing these days anyway, so you want to be a little bit careful with comps. But we look at the yield and what it's going to yield to our investor on a monthly basis. And then we provide a turnkey managed system to assist the client in managing their property, whether it be short or long term. Regardless of what your strategy is, we've got something that we can have fit for your particular needs. I pulled this off CNBC a year ago, and it still is applicable today. Home prices still dropping nationally, especially for distressed properties on the low end of the market. That's where we focus, and that's kind of cool because now we realize that our strategy, which is the lower end of the market, is exactly what the hedge fund and institutional investors have implemented. It's the low end of the market where the value's at. Yes, large-scale investors like hedge funds are in the game now. They do provide some competition. But then how does an individual investor get in without extra cash lying around? And the answer was retirement funds. And we do these webinars with a lot of different financial groups and typically people who manage people's investment portfolios. And probably about 70% of our sales is through a retirement account, an IRA, a 401k, self-directed IRA, even an LLC in some cases. But that's really the largest portion of our customers. Birmingham, Alabama is our chosen market, and there's a lot of reasons for that. CNN Money Magazine says Birmingham is the 10th best overall real estate market in the United States. Also reporting Birmingham the 3rd fastest growing real estate market in the country. We saw a 17% increase in sales prices from 2011 to 2012. We do not deal with the hedge funds as much on the ground in Birmingham as you would in, say, Atlanta or Phoenix or Las Vegas or Memphis, Tennessee, Jacksonville, Florida. We do not see those there. New Wire Investor did a study and said the 10 best cash flowing markets in the U.S. is Birmingham. We can buy property in Birmingham that we can get 12 to 14% yield cash on cash all day long, providing a good quality product that provides a good rate of return in a very strong rental market, and the resale values are very strong. We like Birmingham for a lot of other reasons too. There's lots of stuff. There was actually an article in Time Magazine, or no, excuse me, the LA Times last Sunday travel section profiled the city of Birmingham, and it was really a great article. If anybody would like to see that as well, I've got that electronically. I can send that to you. But this is our chosen market, and we get asked a lot. Why are you in that market? And again, I mentioned earlier the hedge funds are in the low end of the market as well. And there's a reason for that. It's just simple math. And I'll give you an example. I always give the example of where I'm at in Orange County, California. Home prices here were once $650,000 medium-priced home. Now they're down to about $500,000. You can see the difference in cash flow. But I'll tell you what, last night, ironically, I got a 9-home package in Santa Ana, California. Now, that's a great rental market, Santa Ana. 9 homes selling for about $400,000 a home. The yield on average was about $1,400 a month in rent. So a $400,000 house and $1,400 in income. Now it's in California, and that's grand, but in Birmingham, $400,000 will buy you 8 properties, netting you probably about $600 a month. So $5,000 a month in income versus $1,200 to $1,400 a month in income. It's just simple math. And that's the reason why you see these hedge funds and these institutional investors, they're not sucking up. Now, Blackstone is buying a lot in California. I think, Mark, you're probably aware of Blackstone and what they're up to. Blackstone is buying a lot of inventory in California. However, the inventory they're buying is still the low income. They're still buying under $200,000. Now, if you know California, if you're buying under $200,000, you're not buying in Newport Beach or the San Fernando Valley or anywhere in Orange County. You're probably not even able to buy in Riverside or San Bernardino. But you're probably buying in Central Coast is my guess. But the point is, it's just a simple mathematical equation. The yields are greater in these smaller markets, whether it be Birmingham, or whether it be Atlanta, or whether it be Jacksonville, Florida, or Jackson, Mississippi. Those are all areas we can get inventory. Those areas are going to yield you a much higher rate of return on your investment. I'm going to do a couple examples of some financial picture for you, give you an idea of what you tend to see in investing in a piece of real estate. This is a short-term buy and flip model. I'm going to give you just a financial example. There's what's interesting about this buy and flip that we're now offering. A year ago, a buy and flip model we would offer would be 1 year. You'd buy it and then flip it literally within 1 year. And we would be with you during that whole period of the year. We'd take care of it for you. We'd pay all the repairs in that year. We'd do all that stuff. But the flip would be in a year. Now the flip is 3 to 5 years. So it's sort of a hybrid buy and flip, buy and hold, because to be in the market now for 1 year would be almost short-sighted. Unless you have a need to get out for cash purposes, and that's okay. If that happens, we could certainly help you liquidate it. But if you don't need to do that, you need to be in the market for a little while. 3 to 5 years, we're saying you're going to see some significant jumps in values, and during that period of time would be the time. So how does it work? This is how our buy and flip program works. We buy it, we rehab it, we rent it out. 3 years, we sell it for a profit. By the way, it's 3 to 5 years. That'd be market dependent, what the market would look like at that time. We offer a 10% rebate in the first year on rent, and we pay all repairs in the first year. So in the first year, if you miss rent for any reason, if somebody moves out and you're missing rent for 2 months, we pay it. Repairs, if something breaks in the first year, you got a 100% warranty on that. So year 2, you get your net rent. In year 2 and 3, we split repairs 50-50 with the investor. In year 3, we sell it. We split the profit 50-50 with the investor. So what's that look like? If you buy it for $44.9, year 1, you get a 10% rebate minimum. Years 2 and 3, $500 a month, easy. That's a conservative number for rent. So you got $6,000 in 2 years, or per year rather, in profit. If you sell it for just $10,000 more in 3 years, very conservative number at $54.9, you'd make $18,000 or a 42% ROI or 14% annual rate of return on that investment on a 3-year buy and flip model. Now we've got other models too. They're just simple buy and holds. As I said, we've got different management agreements for different strategies. So this is just something that you would a very common buy and hold type of model. This was a $54.9 3-bedroom, 1-half house property in Birmingham, renting for $800 a month, netting out $12.86. That's pretty standard. That's the number that we shoot for. So when we buy something, we make sure that we can rent it for the right number, and we can resell it for the right number. This one is available. The one I just showed you a moment ago has already been sold, but this one is available, and this is already rehabbed out. So it gives you an idea what you're buying. I know a lot of folks, especially if you're from California or even from the West for that matter, when you say $54.9 for a buy and hold, what must that be? That must be some sort of a tent. But in actuality, in these markets, this is what folks are buying. This is what the hedge funds are buying. This is what the REO specialized companies are buying. This little 3-bedroom, 2-bath, $54,000, $735 a month is the projected rent from the management team on the ground there. Very often in Birmingham, you'll get Section 8 renters. About half of our buy and holds at the moment are Section 8 renters. So a projected rent is $735 and an 11.5% ROI on that. So just to kind of recap, and then I'm going to turn it over to Mark Robbins with Lending Resources Group. Our house selection we think is excellent. We'd love to be able to show you some properties. If you have an interest, just contact us. We'll leave our contact information on the screen when we're done. Renovations, you get a little bit of a snapshot of what a renovation looks like from the previous slide. We do the property management in-house. We don't send you to somebody else directly with us. Again, we warranty all repairs and all rents in the first year and continuing ongoing service. Our prices start at $44.9, by the way, and there's no hidden fees in there. There's no escrow costs. There's no commissions. There's none of that stuff. This is a typical real estate transaction. REO Reseller does own the property first, which is one of the reasons why we cherry pick. We own the property. If we can't sell it, we own it for our portfolio. But it goes through Fernley McDonald. They're a title and escrow company. You can Google them. They're one of the top title and escrow firms in the nation. They do all of our escrow for us. Nothing gets transferred into your name, nor does any money go anywhere other than escrow until you sign off on the transaction. So it's all done just as any other normal, typical real estate transaction would take place. Our prices go up to about $80,000. So depending upon what you're trying to accomplish, we have buys and flips as low as $44,900. We have other buy and holds, 5-bedroom, 6-bath houses, homes type of thing. They'll go up to the 70s and 80s. Okay, having said that, I know most of you were on here today to hear from Mark Robbins, CEO of Lending Resources Group. And Mark, again, I appreciate you being on here on such short notice.
Greg, it's a real pleasure. And by the way, that's a great presentation, a lot of information to digest. But bottom line, the opportunity has never been greater, I think, in the past probably 10 years.
Agree with that. And Mark, I'm going to let you take it away again. I'm going to let Mark take it from here. We're going to take questions at the end of this webcast. So again, feel free to type your questions into the chat box in the corner. I'll also leave our phone numbers and email addresses on the screen when the webcast is over, so that you can, get our information and give myself or Mark a call at any time. So with that, Mark, I'm going to step aside and hand you the controls.
Yeah, thanks very much, Greg. Again, welcome, ladies and gentlemen. I am Mark Robbins. I've been a mortgage consultant over the past 11 years. And during that time, I followed a niche that was introduced to me in 2004 by one of the major trust companies in the United States that help people manage their money for real estate investments, in addition to, of course, other investments that people use their IRA money for. But I was introduced to this concept of non-recourse financing and non-recourse borrowing by the president of a major trust company. And bottom line, the IRS puts out a publication. You can see that. It's publication 590. Pages 40 and 41 will tell you what you cannot invest in. And it does not say you can't invest in real estate. So having said that, people have been buying real estate with their IRA money for years, back, I think, as far back as 1973. But up until the 2000 decade, they really couldn't use leverage to buy the real estate. They had to pay all cash. And let's face it, you could only put a certain amount of money in your IRA each year. So the great majority of people don't have enough money in their IRA to pay all cash for real estate. Bottom line, in 2004, the non-recourse financing market came alive because there were a couple of banks that started providing these types of loans. And to this day, there's only a couple of banks that do them. And frankly, they're very, shall we say, vanilla or chocolate as the ice cream flavors go. They don't offer a myriad of product and a myriad of programs for the types of real estate investing that Greg was talking about. When it comes to fixer-uppers, when it comes to homes under $100,000, when it comes to loans under $50,000, because the banks have requirements of minimum $50,000 loans and so on. I won't elucidate on the banks because the purpose of today was to introduce you to a private lending program that I've developed along with an investor that I believe, having done research and having been in this marketplace for 9 years, is second to none. I have not found another private lending source or private financing source that has the programs that I will be introducing to you in a few minutes. So a non-recourse loan is required if the investor doesn't have sufficient funds to pay all cash. Now, what is a non-recourse loan? It basically means that the entity that is lending you money to buy the real estate cannot pursue you if you default on the mortgage payment. The only recourse they have would be to take back the property and any rental income that the property is producing. Otherwise, they have no recourse, hence the term non-recourse, against the individual IRA owner. They can't even go after your IRA assets. No other, you might have other real estate in your portfolio. They can't go after that. They can't go after any cash. So that's what non-recourse essentially means. And because it's non-recourse, again, the majority of lenders out there, the great majority of banks, they don't want to take the risk, even if you're putting 50% down. They don't want to take the risk of having to repossess a property if you don't make the payments. And we know, because of the real estate meltdown, that's happened more than once or twice. So having mentioned that there are only a couple of banks in the U.S. that grant these loans, that's where that stands. Now, the private lender that I have made contact with, and we're working together to close numerous transactions, especially in this marketplace, especially in the paradigm of what Greg spoke about, the less expensive homes, because there is a huge marketplace. And I can vouch for what Greg said, because I'm working with a group, a partnership in Chicago that is connected to the Blackstone hedge fund. They're buying, renovating, and selling properties in the Chicago area. They're going to be doing probably anywhere from 15 to 30 a month. And Blackstone has been given the charter to spend billions on real estate. So that really is just another confirmation of what Greg had to say. Now, as far as the lender's terms, 7%. Now, that's really not a hard money rate. When it comes down to hard money or private money, usually you're talking about anywhere from 9% on the very low end to as much as 14 or 50% on the high end. My private lender will provide 7% interest for investors, and that's on both an IRA non-recourse loan or a recourse loan. Now, my lender does look at individuals' credit scores because of the marketplace that he's in the private market of lending. He has to make sure that he's working with credit-worthy borrowers. So hence you'll see 680 or better credit score is going to determine the interest rate. If your credit score is less than 680, we can still work something out, but it's going to be higher than 7%. Now, he will offer 5-year interest only, renewable for 2 5-year terms, or 10 years, renewable for a 10-year term, or 20-year term. And at no time does the interest rate change when you renew for that program. The 7% stays the same. It's amortized for 20 years. And there's no prepaid penalty if you decide to sell the property earlier than the time frame that you've chosen. The loan amounts can be as low as $20,000. Obviously, we like them to be higher, but 20 is probably the benchmark water level for this program. The other nice thing about this program that the banks won't offer is actually lending up to 65% of the after repair value of a property, as opposed to just 65% of the purchase price. So you can actually borrow enough money to buy the property and fix it up. And that really limits the amount of money that you have to put in, because if that property is worth $80,000 after you fix it up and you borrow 65%, that's $51,000. If the property cost 35 or 40 and it only takes 10 or 15 to fix it up, you're virtually getting 100% financing for that property. I know that nobody else has that program. So that also talks about lending on fixer-uppers, of course. And as far as our fees are concerned, I think that they're tame, considering all of the characteristics that our programs offer, particularly for being able to borrow, to buy, and to renovate at the same time. So it is a $5,000 flat fee on all loans up to $100,000, and that includes my consulting fee, the lender's points, the appraisal, the lenders doing loan documents, processing, underwriting. And I know that in this particular instance, Greg's company offers a rebate because they use their own title and escrow company. Also, the banks require minimum debt service ratios. We do not. we're not concerned about that. So you don't have to have an income that exceeds the amount of debt on the property in order for the loan to be approved. And as I mentioned above, when it comes to just checking credit scores, even though the non-recourse loan is not a personally guaranteed loan, the lender does require to know the credit worthiness of the borrower, even though there's no personal guarantee. So as far as the process of getting started with me and the private loan source, there's just basically a couple of steps. I have a fee agreement, of course, that needs to be signed ahead of time before I reveal who my loan source is. That goes without saying in our business. After that, we do an online application. The online application, which I will walk you through, takes about 6.5 minutes, sometimes 7. And once that's submitted to the lender, that will generate the invoice to send to you for the good faith processing fee. And all the lender really is looking for is to know that the borrower is committed to buying the property, and they're not going to change their mind or walk away, because it's happened many times in the past where the lender started the process, pays staff for their time, pays for processing and underwriting, orders the appraisal, and then the borrower says, oh, gee, I changed my mind. I want to do something else. Well, if there's no skin in the game, then the borrower had nothing to lose. So in this case, if the borrower did change their mind, they would forfeit the processing fee. But if the loan, for any reason, doesn't close at no fault of the borrower, that processing fee would be reimbursed. And once upon the lender's receipt of the deposit, the client's loan will be scheduled for processing and closing. We will use best efforts to help you, the borrower, gather all the required information for the lender.
Yeah, and Mark, thank you for that. And one of the things that we did when we looked at Mark's program was we said, well, right now when we sell somebody a property, we just simply ask them to escrow all their funds. 100% of their funds go to escrow. What we're going to do is we agreed with Mark that we would refund, for the purpose of anybody that attends one of these webinars, we will refund that initial good faith deposit you put up, that $2,000 you put up. We'll actually refund that at close of escrow. So in other words, if you buy something from us at $44,900, for example, your price would be $42,900. So you'd actually recap that good faith investment you put in up front, which sort of offsets some of your closing fees. So that's just a sort of a webinar special that Greg approved that I offer during this webinar today. So I'm going to just put our information up on the screen here. I want to thank everyone for being here today. We've got one more today at 3 o'clock. If you missed any part of this, I did notice a couple people did log on late. If you want to attend the next one, it is today at 3 o'clock. Just let us know. We'll send you the link. We also have 2 more tomorrow, one at 10 a.m. and another at 2 p.m. So we have 2 more tomorrow as well with Mark from Lending Resources Group. Mark, I want to thank you for being here. Let me check the queue and see if we've got any questions in there.
Thank you, Greg.
Okay, we've got no questions in the queue right now, but what I'm going to do is I'm going to leave the screen up. I'm going to hang around here for a few minutes in case somebody's frantically typing in their question. Mark, you might want to hang out for just a couple minutes here. I'm going to hit the mute button.
Oh, sure. That's fine.
Any background noise, but we're just going to stay here for about 2 minutes. If there's any questions at all, just type them in. If you don't want to type them in, you've got our numbers here. You're more than welcome to give myself or Mark a call. And if we don't get any questions, I want to say again, thank you, Mark. I'll see you a little bit later on this afternoon.
Thanks a lot, Greg. I look forward to it. And I might just mention to the people that are still listening that what I gave is in terms of non-recourse explanation was very brief. We didn't touch on anything having to do with taxes, which I can explain to people if they have questions. And I didn't talk about any kind of prohibited transactions. So there's a lot more meat in the non-recourse investment world, but what we really wanted to focus on was the uniqueness of the lending opportunity.
Question here. Okay, Mark, questions for you. Will Mark lend on multiple properties, and what is the maximum loan amount? So will you loan on multiple ones, and what's the maximum loan amount?
Well, we'll certainly lend on multiple properties, but not all at one time. In other words, if somebody wants to buy 10 properties, yes, we can lend on 10 properties, but each property has to be done individually because each property has its own APN number, so to speak. They have their own identification number for for title escrow purposes. We don't do block purchases, let's put it that way. But we might do 10 properties at a time for somebody. So that's not an issue in terms of you're not limited to the number of properties you can buy. The lender will lend up to $3 million on a property. And I don't think that's the marketplace we're talking about. So there's really not a difficult limit when it comes to this price point.
Okay, next question. Do you lend in California or just Alabama? I can answer that question. I don't think we're state prohibited in any state, are we, Mark?
50 states.
That's what I thought.
In fact, if somebody wants to buy something in the Virgin Islands or Puerto Rico, we can do that too.
What about a 6-door apartment house?
We can do that too. I've done commercial properties, so we're not relegated to just residential.
The next question is, do you loan on 2 to 4 units? I think you've already answered that question. I think the answer to that's yes.
Yeah, I've done non-recourse loans or regular recourse loans on numerous times for duplexes, triplexes, and fourplexes.
What about MHPs?
Refresh me. What's MHP stand for? Mass Housing Project?
Mobile home parks.
Yes, we will lend on mobile home parks.
That might be all of our questions.
Okay. Well, I'm certainly game to answer any questions that anybody has, and I look forward to speaking with you, Greg, and attending the next webinar this afternoon.
Mark, what's the closing time? How quick can you close?
The lender needs a minimum of 20 days, but at the outside 30.
Okay.
He can close in less than 20, but he doesn't like to say that he's going to do it, and then for some reason it doesn't happen. So we like to say 20 at a minimum, maximum 30.
Okay. Somebody's asking about the LTV. The LTV is 65% after repairs. Correct, Mark?
That's correct, yes. Up to 65%. Yes.
Yeah, I'm learning already. Okay, I think that's the end of our questions, Mark. If anybody needs anything, you got our numbers up here on the screen. And just for everyone's own edification, if somebody's looking to buy in a market that is not in the markets that we have selected, if you contact me, I can tell you where we can get inventory. We try to focus only in places where we can get we have strong teams on the ground and whatnot. But that doesn't mean if somebody wants a certain market that we can't still point you in the right direction. So contact me. I can give you details on that as well. And with that, Mark, thanks so much for being here today.
Thanks for having me, Greg. I really appreciate it. I look forward to the next one.
Sounds good.
Okay. Take care. Thank you.